Okay, so here begins the example of how to handle transactions when we have to deal with shipping involved in it. So again, and how we calculate discounts and whatnot. So we have the same transaction that we saw in the previous videos, the previous portion of my handout. If you're looking at that as well as a reference point. So again, we have $25,000 of goods that were either sold or purchased on November 10th. $5,000 was returned on the 15th with a cost of $2,000, paid on the 20th. But now we're going to add 210 net 30, so we're going to add F.O.B shipping point. Invoice transportation charges are going to be $750. Again, we're assuming that the seller is passing on shipping cost dollar for dollar with no markup. What I like to call the nice seller example. In other words, they paid $750, we're charging the customer $750. Now, if shipping charges are based on flat fees or other formulas, we would book this as some other form of revenue. In other words, we're charging our customer, like let's say in this case, our cost was $750, but we charged the customer $1,000. So obviously that amount that we're charging them should be booked as something other than, again, it's not really part of the sale, it's like adjacent to the sale, right? It's definitely money coming into us, but again, it's not strictly part of the sale. So we want to maintain the integrity of the sale. So you might label it something as, shipping charges revenue or something like that, because your actual costs out of pocket were $750. So that's where, in other words, you might have the use of like shipping expenses was debited for $750 cash, or maybe accounts payable if you had an account with the shipping company was credited for $750. So that's how you would handle that. But again, to simplify all that stuff I just talked about there, just to take that out of play, we just say, well, what they paid for the shipping is what they're charging the customer. So we're going to first focus on the seller's accounting, because that's going to be, of course, the more complicated accounting here. So you'll notice this, the original example we saw before, right here, except, of course, it becomes 3 lines initially instead of 2. Why? Because this extra line here, this is what you're looking at right there, that cash credit of $750, that's the amount of the shipping, right? I said it was $750 of shipping, so they paid $750, but guess what they did with it? Because it's F.O.B shipping point, they're not absorbing that cost, they're passing it on to their customer. So their customer now owes them an additional $750, so it's added to the AR balance. And again, just for argument's sake, this could also be accounts payable as well, meaning that we have an account with the shipping company and we'll pay that balance later, at a later point in time. Now, as far as booking the cost of the sale, that's the same as the original example. Just cost of goods sold, debit, inventory credit for $10,000. No change there whatsoever. All right, so what about the return? Guess what? The return is the same. No changes at all. No change at all. So really, the only change we have so far, right there. That's it. That's all we have to do. We have to add some extra line to express the cost of the shipping in some way or the other, right? Like, what did we charge our customer for it? Whatever that amount is, whether it's in the form of a cash payment or an account payable that we're assuming temporarily, when you think about it, because again, we're going to be ultimately reimbursed by our customer for the $750. So it's going to wash out there. That's where the money's going to come from. That. So it's still not coming out of our pocket. And just a little digression here. I really don't have to say this right here. How, in reality, do we determine shipping terms? By facts like this. Invoice transportation charges are $750. In other words, you look at the invoice that was sent to you if you're Burroughs, or the one you sent out to your customer if you're Vonnegut, and you see $750 on the line for shipping costs. Okay, so who paid? Well, since the buyer paid, we know it's F.O.B shipping point. That's really how you determine it. It's determined by who simply paid. It's really that basic of a concept. Who paid? Oh, the buyer did? Well, that's F.O.B shipping point. If that line is blank, well, then it's F.O.B destination, because what? The seller picked up the cost. So that's really how those terms come into practice. They're not usually specifically delineated. We just interpret the absence or the inclusion of a shipping charge on an invoice to determine what we're dealing with. So here we had something on that line, so we know it's F.O.B shipping point. So that's the reality. So that means every time you buy something and you didn't pay for the shipping on Amazon, because you have Amazon Prime, like a lot of people do, that means what? It was F.O.B destination. You didn't own the goods in transit. So technically, who owned it? Amazon did, or whatever the seller is that shipped them to you, if it wasn't from Amazon directly. All right, so to recap, the only main change we have here is this extra line for the sale. Cost of the sale is the same, and the sales returns and allowance is the same. So what's going to change with the payment within the discount period? Well, actually not that much, because really, only thing you'll notice here is that our accounts receivable balance was $20,000 in the original example, and now it's $20,750. There's an extra $750 hanging out from the shipping. So there's that. And then as far as what's going to be added to the ultimate amount paid, well, let's go through the math again. So we had $25,000 worth of goods minus $5,000 that was returned, right? So we had started at 20, $5,000 was returned here. So we had $5,000 returned, so that's $20,000 worth of goods. Right, so we got our 20. That's supposed to be a K, but I don't know what that really looks like. Some sort of hieroglyphic. So again, we're going to take 2% of that, because that's the amount of the goods, and no shipping's included there, and we get what? We get $400. That was the same amount as the original example. In other words, we're going to accept $19,600 for the, that was supposed to be 10, instead it looks like a couple of zeros that may be merged together there, 19,600. So plus the 750. You think I'd be getting better at that? I guess not. Plus the 750 equals the amount that we received. That's it. So in other words, our customer paid us 98% of the goods that they kept, because they kept $20,000 worth of goods. 98% of that would be 19,600. Plus 100% of the shipping is 750 equals 20,350. So in other words, the change here was that we had this extra 750 hanging out there, and of course we had 750 added to the original 19,600 that we calculated in the discount example after a return. All right, so again, writing with the mouse is still a point of contention. All right, so if we switch to, now we're going to look at how does the buyer handle those transactions. Well, it's just going to be like everything we saw here, and I will do a little bit of cleanup so that this doesn't look so crazy. Might as well get rid of that because it really is hard to read anyways. All right, so the buyer is, again, simpler accounting as promised. So the initial point of purchase is going to look like so we're going to have inventory debit, accounts payable credit. Simple as that, which of course just matches what we had here. But again, less information, right? So in other words, instead of having 3 lines like we see here, no, 3 lines, it just gets boiled down to just 2, which is what were they charged for the goods that goes in inventory, and of course likewise goes to accounts payable. So inventory goes up 25,750. Accounts payable goes up 25,750 because that's what their invoice said. Invoice bottom line said you owe us 25,750, so that's where the number comes from. And the return, same as the original example. And then what about the payment within the discount period? Well, everything we saw over here, in other words, these 3 numbers here, same 3 numbers, just used a little differently. In other words, on an account that we owed $20,750 on, we remitted $20,350. And again, what's the math there? Same as we saw before. In other words, they paid $19,000. This actually looks like it might actually look like a number. $600 for the goods, plus, again, that's 98%, plus $750 for the shipping equals our $20,350. And of course, the amount of the purchase discount is the same as the original example, $400. And that's going to be the reality here because we're not taking discounts on the shipping costs. It doesn't change our discounts. Our discounts remain the same as the original example. We just have this extra cost for the shipping hanging out in there. That's it. And the same rule that I talked about earlier for purchases still applies. In other words, they were charged $25,750 for inventory. They subtracted $500 from that, so $20,750 minus the $400 that they didn't pay because they paid within the discount period equals the ultimate increase. I'll try to make a whole equal sign there. Looks like I'm maybe stacking pancakes, whatever, equals $20,350. So we have the same parity rule at play. In other words, total cost of inventory is $20,350. So when they figure out the unit cost, they'll have a better idea, again, about what the margin is that they're getting from each unit, therefore how much they should sell each unit for. Okay, so everything you're looking at here was because we had FOB shipping point, because it was $750 on the invoice sent to the customer. Now, what if we say now there's nothing on the invoice, right? So we're going to have FOB destination. And again, the easiest way to indicate that is we look at the invoice and it says no charge, or that line for the shipping cost is left blank. So the only change we have now here is this. So the actual accounts receivable debit sales credit's the same as the original example. Same cost of goods sold debit, inventory credit as the original example. The only change we would have is these two lines right here. We would have to book delivery expense with a cost of $750, debit that cash credit, or again, alternately, you could end up having a credit to accounts payable if you had an account with the shipping company. So then that's going to be your change there if you go to destination. So really, all the trouble, so to speak, is being caused by FOB shipping point. FOB destination is a very minor departure from the original example. Okay, and that concludes dealing with, again, the practical way of dealing with shipping terms and shipping costs in terms of how it affects the transactions. And again, what was the big lesson here? You don't take discounts on shipping costs, so it doesn't matter if you had shipping involved or not, you'll end up with the same discounts given the same basic information set. So there will be one additional video in the subject matter. We'll just tackle the changes in your financial statements and any additional adjusting entry changes. And that's all for now.